Hello, everyone. This is Joe Boston with Real Estate for Life. Today, we're going to talk about seller financing. This is a previous presentation that I provided, and it's a high level overview of seller financing. Next month, we're going to be focusing on seller financing because of the market right now. We feel that it's going to be very popular uh, for investors to buy and sell. The price points in the Dallas Fort Worth areas where we're located have increased. And also, along with that, when you start talking about principal, interest, taxes, and insurance, what makes up your payment, the taxes and insurance have sometimes gone up 4 times the amount, and the insurance is doubled. So if you're a landlord, that severely can impact your cash flow. But with seller financing, obviously, uh, you are actually selling the property, and the buyer will be responsible for the taxes and insurance. So you will just realize the actual cash flow from the principal and interest, and then also negate having their responsibility for the maintenance, as well as the taxes and insurance. So there's many benefits to doing seller financing. We're going to talk about that a little bit. There are some, possible drawbacks as well, but we want to highlight that. And again, at the Dallas Real Estate Investment Group, September is going to be our seller financing month, and so we're going to be taking a deep dive with what we call an opportunity circle that we actually focus on specific exit strategies, and seller financing is going to be the one that we highlight in September. And so I really like this strategy now, more than ever, and primarily because of what's happening with the market. Right now, with interest rates being high, it can cause a dilemma if you're going to sell or finance properties that you're going to try to purchase now. However, typically with a seller financing option, you're going to increase the sales price because you're offering terms, because you are acting as the lender. But if you do have existing properties, if you're a landlord with a portfolio, this could be a perfect way to transition some of those higher expenses into uh this process, and eliminating that for you and still gaining the benefit of the cash flow. So if you do have a portfolio or several, just a couple rentals, this might be an opportunity for you to transition into seller financing. Okay, so this disclaimer, this is just a presentation for general purposes. This isn't legal or financial advice. So just know that real estate investing can be inherently risky. So just make sure that you're getting educated and reaching out to individuals that are subject matter experts or legal counsel before you move forward with any type of transaction. So, what is seller financing? It's a loan provided by the seller of a property to the purchaser. Usually, the purchaser will make some sort of down payment, which then will be converted into installments, usually a monthly basis over a specific time period at an agreed upon interest rate until the loan is fully repaid. So you are acting as the lender and not the owner landlord. So who uses seller finance? Buyers and sellers, right? As an investor, if you're acting in that role of the property, you can use seller financing as an option to get a property for a cost of the down payment. So sometimes, and maybe like in 2008 and 9, and now that prices are going up, if buyers are underwater, they might want you just to take over their payments, and for a nominal down payment. And the down payment could just be what they're behind, the amount they're behind, and then they'll allow you to take over the payments. That process is called a subject to, but also there are seller financing aspects of that. And so uh, at our workshop, we actually will go into those details. And as an investor selling a property, you can practically name your price, meaning typically there's an increased amount placed on that sales price because you're offering terms, and you can qualify your buyer. There is what's called an RMLO that will assist you with that. Uh, but you can increase the sales price as much as 20%. Now, again, it depends on the market you're in, and if it doesn't breach and exceed the reasonable increase of your market value. But typically, there is an increase. It could be 10 to 20% of the sales price. So, how to sell it? So, it's all about them. So, if you do have a property that you're interested in obtaining via seller finance, here's what you're looking for. So, high days on market, if you're looking for properties that might be fit this category, uh, market value slippage, due to many variables in the market, the condition. If it's for sale by owner, you might approach them with this option to quickly move to sell the property. If they're having money issues, like I said, they're behind. It provides instant cash because you can provide a down payment. There's no repairs required on the seller's part because you're going to take it as is, and you can do it with no closing cost option. You can offer to pay for the closing costs because it's a different process. There's no realtor that has to be involved. You can use one, but there's no need to if you learn the process. And there's no staging or interruptions to do this. So one of the processes we say is the wow theory. What's it worth? What do they owe? And what do they want? And so we use that theory to actually approach selling the property or approaching someone that wants to sell their property. So again, it's called the wow. It's what is it worth? What do they owe? And then what do they want? So it's what does the seller want? And sometimes if they're behind, they just don't want to have, any type of negative impact on their credit. So this could save their credit and allow them to move on to purchase a property in the future. So they might just want to transition out of the property. In addition to that, you can make arrangements. You can create a process that it's a short-term financing option, and then a balloon, which means that the outstanding balance of the loan is due. So uh, the seller financing arrangements, a typical deal might be for the loan to be amortized over 30 years with a balloon payment after 5, which means after 5 years, then they get another loan and pay you the balance, the outstanding principal sum, which is a great deal, right? Because if, like we said, if you're marking the property up and increasing the value, then you can realize that difference. Typically, with an amortized loan, uh, it's front loaded, which means that you're paying interest in the beginning and very little principal. So if you keep it for 5 years, for the most part, they've just paid interest. So it's a very good, lucrative way because after the 5 year period, you've still owed pretty much the majority of your balance. And so we call it like double dipping, where you can get your interest and your original loan balance. So, what are some of the pros and cons for the buyers? Seller financing lets people who might not be able to secure a mortgage buy a home, and the seller might be okay even if a bank or other traditional lender turned them down, right? So the down payment offsets some of that risk. That's one of the reasons why we obtain a down payment. The closing process is faster and cheaper because of the documents. And if you're acting as the lender, obviously you're somewhat stepping into the underwriting role. The down payment can be whatever you negotiate. Typically, the industry standard is 10 to 20%, but it's up to you, depending on the value of the home. The cons for the buyers, the interest rate might be higher uh, than the existing market if they were going to go to an institutional bank. The credit risk, seller may still run a credit check. So sometimes the buyer might not have any credit, or they might have negative credit, and that restricts them from getting a traditional mortgage. The buyer could be turned down if they're a credit risk. So, that's one thing that could be a con for them. And then the balloon payment, they might not be able to qualify after that 5-year balloon. Uh, but if that's the option, that could be a down, something that they don't want to do. So that could be a negative. The pros for sellers are it's a quicker sale potentially. If they have trouble selling, you might open up your buyer pool to people that can't get a traditional mortgage. When you can sell your house as is, instead of making costly repairs, it might be required by the traditional lender to be sold as is. And so this allows you to do that. You can get a better rate of return because typically your interest rate's a little higher. And then you can keep the down payment if the buyer stops making payments. So, of course, you'd have to go through all the formality steps of foreclosing, but you did get a down payment to offset some of your risk. And then you can cash out if needed. The seller can sell the promissory note. That's the note business. But if you do have that note and it's a qualified mortgage, then you'll be able to sell that note at a high percentage rate. So that allows you to sell, and if you need the money right away. So cons for sellers: the buyer could stop making payments at any time. Most of the time, when buyers default on a loan, they feel bad and just walk away. I've had that happen. The buyer defaults, you might incur repair costs depending on how the buyer cared for your property. But again, because they're the owner, usually they're taking better care of it as than if they were a tenant. And then taxes could be complicated, right? So, how you handle paying for taxes could be a little different. But that if you have a real estate CPA, that shouldn't be a problem. So why do the clients do it? So foreclosure, they've had that in the past. They've lost their jobs, so their credit isn't, up to par. They're relocating, need a fast move, divorce. This is one way to transition out of that. Uh, Family assistance, they want to relieve the burden to a daughter or son. Don't like home ownership. There's people that just don't, especially in this day and age. Different generations just don't like it. It just doesn't appeal to them. See a deal and need to sell the house to qualify. This will meet that criteria because it's actually a sale. No credit check, death. The heirs cannot agree, so they can transition it. And then financial hardship. That's definitely a reason. But there's several reasons why, and in this market, it's gonna all these things could occur, and so you're going to need to know. You should need to know some of these details, and then if you have these skills, an opportunity can present itself. So the 8 steps to an owner finance deal is: number one is get an appraisal, or we call a BPO, a broker's price opinion, or comps on the home. Number two, create the homeowner financing paperwork, and that's one of the things we're going to talk about uh, next month. But also, we are going to have a package that we're going to sell that'll allow you to do it yourself, or we have an opportunity circle leader that will allow you to have them help you through this process. Next is establish a plan in the event of default for foreclosure or forfeiture of home. One of the things that offsets that is the down payment, like we discussed. Number four, let's consider background checks to determine the risk of your owner financing transaction. Do as much due diligence as possible, but sometimes, depending on where they're from, where the buyer's from, could prevent you from getting a lot of information. Number five is determine a fair down payment and interest rate. You're going to look at the market. Currently, the market interest rates are high, so you have to make it so that the payment is reasonable. Most people can afford it. So that can be a hindrance to doing seller finance, but the thing is, you got to look at the balances. There's many different variables in the payment. Number six is agree on an interest rate and a term with the buyer. Number seven is ensure that the contract between the parties is recorded legally. And again, We close ours always at a title company. And so it's really important that you do this the right way. And then we use what's called number 8, a loan servicer, to manage the payment. So we require that so that you're not actually having a job and you're hiring a third party to manage all the payments and escrows. So let's talk about a common seller finance strategy. It's called a wraparound transaction. And what this is that there's an existing loan that's in place and you're creating a second loan that's higher than the existing loan. And that's the secondary loan is basically going to be in your name or your business's name. And that's where that's who the buyer is going to pay. And what happens is that the existing loan, let's say that it's 100,000, that's the balance, and you're paying $1,000 a month. Well, your secondary note is going to be to the buyer for, let's say, 150,000, and that payment's 1,500 a month. So when they make the payment to you, you're then going to turn around and make the underlying payment of the 1,000, and the balance is going to come to you as the lender. But what we call that process is a wraparound transaction. And there are rules and regulations. We're going to cover that next month. But that's pretty much what a lot of investors do now. There is something called a due on sale clause, which we do have those disclosures that we'll talk about, but we rarely see that happen. But again, there's the rules are changing all the time about licensure, how many times you can do one of these transactions without being licensed. So we'll cover that as well. So some of the common seller financing forms is the application, the contract, that is going to be state specific depending on where you're located, power of attorney, an authorization for insurance, promissory note. There's clauses. There's going to be some that we specifically have geared towards uh, doing this process that you're going to need to have as far as disclosures, maintenance and repair worksheets, access to property worksheets, the foreclosure and eviction process. We're going to need to know how that works. A seller and a buyer referral workshop. And these are for how you actually disclose what you're going to do with the buyer and seller, to make sure that those documents are in place and you're meeting all the regulatory requirements. And then the custom contracts that we have and the various types of language that needs to be put into these contracts. So this is a high level of what these forms are. Some of these are covered in our processes that we actually offer at the group. But just to give you a high level of it's more to it than just a regular contract and a seller financing addendum. It's a little bit more. It's a lot more detailed than that to stay in compliance. And that's one of the ways why I want to highlight that and let you know, at Dallas REIG, we're going to cover this process. The whole month is about seller financing, and you're going to want to know this process. In my opinion, I think this is the exit strategy that a lot of people that want a return on investment without a lot of labor are going to turn to. It's getting more and more popular as prices do increase and expenses increase. This is one way to look at keeping your cash flow without the headache of being a landlord. So, wanted to highlight this and give you some information about it because we feel it's very important that you know this process. So, thank you for attending and watching this again at the Dallas Real Estate Investment Group, and that's DallasREIG.com. The month of September is going to be for seller financing. And so we want you to attend. And again, that's DallasREIG.com. And so if you are interested in this process, which I think that the majority of investors will start to trend towards this great exit strategy, then please attend and join, and then we'll be able to help you. So until next time, we'll see you later. And thanks for watching Real Estate for Life.